Everyone loves the idea of a final retirement date, stepping away from the desk, turning off the alarm clock, the ultimate finish line, right? But here's the part no one talks about. A hidden tax mistake in retirement doesn't just trim your budget, it can quietly dismantle decades of diligent savings. Same nest egg, same retirement date, very different outcome. And for some people, this single tax blind spot ends up costing more over a lifetime than almost any market downturn ever could. Hi, I'm Larry Sprung with Mitlin Financial. Keeping more of your hard-earned savings is often positioned as simple math once you stop working. And to be clear, it should be. When a tax strategy is done thoughtfully, your income sources align to give you total control over what you pay the IRS. But when retirement is entered without a plan, assuming your money is automatically tax-free can backfire in ways most people don't see until their first tax season without a salary. Today, we're walking you through three things: the primary account types and why retirement income isn't inherently tax-free, a mandatory IRS rule that can push you into a surprise tax bracket, and the hidden trigger that can quietly swallow your Social Security benefits. And along the way, I'll share a story that still stands out to me today. Point one, not all retirement accounts are created equal. The tax bucket trap. At its core, a retirement plan is a collection of distinct tax buckets. It's not one giant pool of cash. It's not inherently tax-free. You have three primary types of accounts, and the IRS views each completely differently. This is where many people get tripped up. First, you have taxable accounts, like a standard brokerage account where you pay capital gains. Then you have tax-free accounts, like a Roth IRA, where you pull your money out without owing a dime. But the third bucket is where most Americans hold their wealth: tax-deferred accounts, like traditional 401k or traditional IRAs. To give you an idea of just how heavily weighted we are in this tax trap, data from the Investment Company Institute shows that nearly 60% of all U.S. retirement assets are sitting in tax-deferred accounts like traditional IRAs and employer-sponsored plans. That's trillions of dollars that have yet to be taxed. What often gets overlooked is that every single dollar you withdraw from a tax-deferred account is taxed as ordinary income. If you spent your career assuming your $1 million nest egg belongs entirely to you, you're in for a shock. The IRS owns a substantial chunk of that balance. The irony is that many retirees think their tax brackets will automatically plummet. But if you tap the wrong bucket at the wrong time, you can easily end up paying the exact same high rates you paid when you were working. This is why good retirement planning starts with an understanding of asset location and your true after-tax income, not just the raw total on your statements. Point number two, the forced withdrawal trap, also known as RMDs. Another factor that can quietly make or break a retirement plan is the arrival of required minimum distributions, or RMDs. This is not an optional withdrawal. This is a mandatory order from the IRS. And if you think people have this all figured out, think again. Research from the Employee Benefit Research Institute revealed that nearly 30% of retirees over the age of 70 end up withdrawing more than their required minimum, often entirely by accident, simply because they don't understand the formula or how the tax timing works. That mistake triggers entirely unnecessary tax bills. Under the current tax laws, once you hit age 73, and eventually that's moving to age 75, the government forces you to start taking a set percentage out of your traditional IRAs and 401ks every single year. Think about it this way. Even if you don't need the money to live on, the IRS requires you to withdraw it so they can finally collect their taxes. If you have a large traditional account, these forced distributions can stack up fast. They act like an artificial salary, potentially pushing you into a much higher marginal tax bracket. And on top of that, missing an RMD carries a steep 25% penalty on the amount you failed to withdraw. This reinforces the same idea. True tax diversification means building tax-free options early so you aren't at the mercy of forced government withdrawals later. Let me share that story I mentioned to you earlier. I remember sitting down with a couple, and I'll call them Diane and Jim. They had done almost everything right. They saved consistently for 35 years, maxed out their 401ks, avoided debt, raised 3 great kids. By every measure, they were a success. Jim leaned back in his chair, smiled, and said, "Larry, we finally made it." Then he slid his tax return across the table. "I don't understand why we owe this much. The investments had done well. The market wasn't the problem. The problem was how they were taking their income. Almost every dollar they needed was coming out of their traditional retirement accounts. On paper, they thought they were just spending their own money, but the IRS, they saw it differently. Every withdrawal looked like income. Then something else happened. Those withdrawals caused more of their Social Security to become taxable. Their required minimum distributions were beginning to kick in, and now they were forced to take out more money than they actually even needed. Jim looked at me and said something I'll never forget. He said, "Larry, I spent my whole career trying to pay less in taxes, and somehow I'm paying almost as much now that I'm retired." That's the part so many people miss. Retirement doesn't automatically lower your taxes. It simply changes the rules. The good news, this wasn't a problem we simply had to accept. We built a strategy around which accounts to draw from, looked for opportunities to move money into Roth accounts over time, and planned years ahead instead of one tax return at a time. The goal wasn't to avoid taxes altogether. It was to stop giving away dollars they didn't have to. After working for decades to build wealth, you want your money helping you enjoy life, to pass down to your children, not create surprises every April. Point 3, the Social Security tax surprise. The final piece of this tax puzzle is a calculation that catches almost everyone off guard: how your retirement income affects your Social Security. Many people believe Social Security is completely tax exempt, but the reality is far different. Depending on your provisional income, which includes your adjusted gross income, tax exempt interest, and half of your Social Security benefits, up to 85% of your Social Security check could become subject to federal income tax. And this is a domino effect. When you withdraw an extra dollar from your traditional 401k to pay for a vacation or an unexpected bill, that withdrawal doesn't just trigger ordinary income tax. It can simultaneously push more of your Social Security into that taxable column. This double tax hit can quietly erode your purchasing power. Strategic planning is less about guessing what future tax rates will be and more about creating structural control over your income sources today. Retirement tax planning doesn't have to be complicated, but it should be intentional. 2 people can retire with the exact same amount of savings and have completely different outcomes, not because of how they invested, but because of how they withdrew their money. The good news is that many of these tax surprises can be avoided. And once the tax year ends, there's no rewind button. That's why planning ahead matters. Not to avoid taxes altogether, but to avoid paying more than you need to. If you're approaching retirement or if you're already there and want to make sure your wealth is protected, this is a topic worth bringing your financial advisor and your CPA together for a conversation. The best tax strategies don't happen in a vacuum. They happen when everyone is working from the same game plan. Ask them questions like, what does our withdrawal strategy look like over the next 10, 20, or even 30 years? How will required minimum distributions affect our taxes and Medicare premiums down the road? Can we benefit from Roth conversions or qualified charitable distributions to lower our future tax burden? Retirement isn't just about accumulating wealth. It's about keeping more of what you've worked so hard to build. When your advisor and your CPA work together, you put yourself in a much stronger position to make informed decisions, reduce unnecessary taxes, and create more flexibility for the life you want to live. Because at the end of the day, the goal isn't to make the IRS your biggest beneficiary. The goal is to give yourself more opportunities to enjoy the retirement you've spent a lifetime earning. If these are things that keep you up at night, that you're thinking about, how am I going to get these monies out of my retirement accounts without paying more to the IRS than I have to? Well, those are things that we help families with each and every day, and we'd be happy to help and guide you as well. I'm Larry Sprung from Mitlin Financial, where we strive to bring joy to your money journey. Be sure to hit like and subscribe so we can see you next time.